Welcome to The Explainer, everyone. Today, we're going on a pretty wild ride. We are going to trace a direct line from the complex geopolitics of the Middle East straight down to your stock and crypto portfolios. Now, I know it sounds like a massive leap, right? But I promise you, by the end of our time together, you're going to see exactly how all these dominoes fall. We're going to use a macro to micro funnel approach. We'll take global conflicts and then zoom all the way in to see exactly what they mean for the future of assets like Bitcoin. Okay, let's dive right into this.
Here's our roadmap for today. We're looking at Iran's economic resilience, the Hormuz mistake, asking if an oil flood is coming, checking out the absolute strength of the tech sector, and finally diving into Bitcoin's next target.
All right, part one, Iran's economic resilience.
So our first big question of The Explainer is this. Just how long can the Iranian regime actually withstand the crushing weight of international economic pressure? It's basically the million-dollar question driving so much of the tension in the Middle East right now. Well, the math keeping them afloat is really fascinating. Right now, the regime is exporting roughly 250,000 barrels of oil every single day. And because global oil prices are riding pretty high, this secures the US dollars they desperately need. What do they do with those dollars? Two main things. First, they fund domestic payrolls, essentially paying people to prevent social unrest. And second, they finance some highly sensitive international payments, like purchasing missiles from China. So literally, as long as the oil price stays elevated, their economic engine just keeps on turning. And that brings us to this incredibly counterintuitive tactic they're using on the world stage, the provocation strategy. I mean, why would Iran's Revolutionary Guard deliberately target the oil infrastructure of their neighbor, the UAE? Well, it's totally calculated. It's meant to trigger retaliation. If regional tensions skyrocket, global oil prices spike right along with them. And a spike in oil translates directly into more US dollars for the regime's survival. It is pure, high-stakes economic theater.
Moving down the funnel now, let's hit part two, the Hormuz mistake.
Which leads us to our second big question. By moving to close or restrict the Strait of Hormuz, was this a strategic masterstroke by Iran? Or was it a massive, historic blunder?
The answer gets pretty clear when we impartially map out the winners and losers. Surprisingly, the beneficiaries might catch you off guard. We've got the United States, Russia, and Canada. The US actually gains here from a stronger dollar and increased domestic oil revenues. Meanwhile, the ones taking the hit are Europe, Asia, Africa, and ironically, Iran itself, due to lost export efficiency. So they intended to squeeze the US, but inadvertently gave the American economy a boost.
But you know, the long-term consequence is even more severe. By weaponizing the strait, Iran essentially showed its hand and exposed its own vulnerability. Because what is the rest of the world doing right now? They are actively and aggressively seeking out brand new, permanent trade routes to bypass this choke point altogether. It's a classic case. When you overuse a point of leverage, you force the world to engineer a way around it, and that permanently weakens your own strategic power.
Okay, on to part three, an oil flood? Let's pivot from geopolitical straits to the global commodity level. Question number three, are global markets about to be totally flooded with an oversupply of crude oil? You've probably heard some prominent analyst out there loudly predicting a massive supply dump, but let's look at the actual facts. Despite all the noise, an oil flood is highly improbable right now. Sure, OPEC increased their production limits, but their actual physical output hasn't surged at all. Key players like the UAE are acting very cautiously to protect their profit margins. And over in the US, while they are increasing exports, they're doing it by aggressively depleting their strategic reserves, a move they absolutely have to reverse eventually. Because of all this, oil is likely to remain elevated in that $70 to $80 range. High, yes, but still comfortably below the major technical resistance level of 103.5.
Now, why does that specific price range matter to you and me? Take a look at this number. 3%. That is the Atlanta Fed's estimated GDP growth for the U.S. in the second quarter. It is a crucial stat because it proves that the current elevated oil prices, while definitely annoying at the gas pump, are not actually dragging the broader global economy down into a recession. The economic engine is absolutely still humming.
Which brings us perfectly to part four, the strength of the tech sector.
That resilient economic growth bridges us directly into specific financial markets. And here is the burning question for pretty much every equity investor out there. With bearish sentiment creeping into the news cycle, is there still room for growth in major markets like the S&P 500 and the NASDAQ?
The short answer is yes, and the historic scale of what we're witnessing is just staggering.
When you compare the tech sector ETF, the XLK, against the broader S&P 500 ETF, the SPY, you see tech reaching levels of relative strength we literally have not seen since the year 2000. Tech isn't just quietly participating, it is completely dominating and dragging the rest of the indices upward with massive underlying momentum. And we can pinpoint exactly where that momentum lives. The Magnificent Seven mega-cap tech stocks are pushing incredibly hard against historical ceilings. If these giants break through, it could trigger an absolutely explosive upside acceleration for the entire market. Before we even see a meaningful correction, the bears, they might just be early to the party.
All right, entering the final stretch, Part 5, Bitcoin's next target.
We've reached the final stage of our macro to micro funnel. We've gone from the Strait of Hormuz to tech stocks, and now we arrive at the highly specific, incredibly volatile world of decentralized assets. So here is our final big question. Bitcoin has been on an absolute tear lately, crushing predictions of a prolonged crypto winter. But what is actually driving this current rally? To find the truth, we kind of have to pivot away from some very popular crypto myths.
The biggest takeaway here is that we need to stop looking at the calendar and start looking at the factories. Forget that mythical 4-year halving cycle that everybody relies on. It's a narrative that honestly fails pretty often. The true macroeconomic indicator that's actually melting the crypto winter is the industrial activity cycle. This is an economic metric measuring global industrial output. When it crosses the threshold of 50, it signals true economic expansion. And historically, this real-world metric aligns with Bitcoin's massive rises way better than some arbitrary 4-year timeline. Simply put, Bitcoin is responding to global liquidity and industrial expansion. And that economic expansion is exactly what just drove Bitcoin to shatter this massive psychological and technical resistance level, $80,000. It wasn't magic, folks. It was pure macroeconomics hard at work. So let's map out the projected path for Bitcoin's price discovery moving forward, step by step. Step 1, the asset needs to establish a solid floor and hold support above 79,500. If it can consolidate there without breaking down, we move to step 2, which is targeting the next major friction point at the 85,000 level. And in step 3, if the bulls can smash through that 85K wall with enough volume, it essentially unlocks the door to a completely new paradigm. We are talking the 100,000 to 125,000 range. Now that is something to watch.
Wow, we have covered some incredible ground in this explainer today. We've seen how Iranian regime survival tactics in the Middle East affect oil choke points, how oil output drives U.S. market stability, how that stability fuels the tech sector, and finally, how industrial expansion ignites Bitcoin. It's like a giant puzzle and it is all connected. So I want to leave you with this one provocative thought. If global geopolitical conflicts and real-world industrial activity are truly the hidden hands dictating our financial cycles, is your portfolio actually positioned for the next link in this chain? Take a good hard look at your strategy today and ask yourself, are you just reacting to the daily news, or are you following the macro to micro funnel? Thanks so much for joining me today. Keep learning, keep analyzing, and I will see you in the next explainer.